Your bank charges you $35 because you are $4 short. Think about that. You do not have enough money. So the bank takes more of it. You call. You explain that your paycheck lands tomorrow. The answer is polite. The fee stays. Right now, you are not valuable to the bank. You are a risk with a debit card. And that is the first thing nobody tells you about banking. Banks do not treat everyone the same. They price you. At almost $0, you ask the bank for permission. Permission to borrow. Permission to avoid a fee. Permission to get through the month. But if your wealth keeps growing, that relationship starts to flip. And by the time you reach $100 million, the bank is no longer asking whether you qualify. It is asking what it has to do to keep you. But first, you have to survive being the customer nobody wants. 2 months later, your car dies in a supermarket parking lot. The repair is $1,800. You have $600. So you open your banking app and apply for a small personal loan. Rejected? You try a credit card. Rejected again. The bank that happily lent you money when you bought lunch all month will not lend when you actually need it. That feels personal. It is not. The bank sees unstable cash flow, low reserves, and no assets it can rely on. You see a broken car, the bank sees probability. So you borrow from family, fix the car, and make a decision. The next time something breaks, you do not want a bank deciding whether your life keeps moving. You build $10,000 in cash. Nothing dramatic happens. No private banker calls. No one sends champagne. But 6 months later, the washing machine floods your apartment. The repair, replacement, and damaged floor cost nearly $3,000. This time, you do not apply for anything. You pay. And that tiny moment matters more than it looks. Because your first level of wealth does not make the bank treat you better. It makes you need the bank less. That is your first piece of leverage. Then you build $100,000. And you assume the bank will finally see you differently. So you apply for a mortgage. You walk in thinking the savings account will impress them. It does, for about 30 seconds. Then they ask about income, debt, credit history, monthly obligations. Your net worth is growing, but your salary is still ordinary. The bank approves less than you expected. That is the next surprise. Having money and being bankable are not exactly the same thing. At this stage, the bank still cares most about whether your monthly cash flow can carry the loan. Your $100,000 gets you through the door. It does not let you rewrite the rules. Not yet. And then your account crosses $1 million. That is when the phone starts ringing. The call comes on a Tuesday, a number you do not recognize. You almost ignore it. It is your bank. Except this time, nobody is calling about a fee. They want to introduce you to someone, a relationship manager. You laugh at the phrase. 3 years ago, your relationship with this bank was a red overdraft warning. Now it apparently needs a manager. You agree to the meeting. When you arrive, something feels different. No ticket, no line, no plastic chair beside the ATM. You are shown into a small room. Coffee appears, then comes the pitch. Better lending rates, investment services, a dedicated contact, access to products you were never offered before. The building has not become more generous. You have become more profitable. At $1 million, the bank no longer sees only your salary. It sees deposits, investments, future loans, and fees. Your value to the bank is becoming larger than any single product, and that changes the conversation. Then you find a small business you want to buy. Purchase price, $2 million. You have enough money to buy it outright, but you do not want to put nearly everything you own into one company. So you ask the bank to finance part of the acquisition. Now the meeting gets more interesting. The bank does not ask whether you can afford a monthly payment like it did with your first mortgage. It asks what the business earns. Customer concentration, cash flow, assets, debt service. What happens if revenue falls 20%? For the first time, the loan is being judged partly on what you are buying, not just on you. That is a major shift. When you were broke, debt was something you used because you lacked money. Now debt can be something you use because you have money and do not want all of it trapped in one place. The bank agrees to finance the deal. But there is a catch: personal guarantee. If the business fails badly enough, the bank can still come after you. You sign. And for 2 years, the business works. Cash flow grows. The loan balance falls. Your net worth moves past $5 million. Then the economy turns. Sales drop. One morning, your banker calls before you have finished coffee. The tone is different. They want updated numbers, not next month, today. This is where wealthy people learn something uncomfortable. A bank can treat you like a great client and still protect itself before it protects you. You send the numbers. The business is still healthy, but the cushion is smaller. The bank does not panic. It does tighten. More reporting, less flexibility. No new borrowing until the numbers improve. Yesterday, leverage made you powerful. Today, the same leverage gives somebody else a seat at your table. That is why being wealthy does not automatically mean being free. The structure matters, so you spend the next few years changing it. More cash, less fragile debt, longer maturities, more than one bank. Your wealth crosses $10 million. And now, the banks start competing. One offers a lower rate. Another offers a credit line against your investment portfolio. A third invites you to a private dinner you absolutely do not want to attend. This is the stage where banking begins to look luxurious. But the most valuable benefit is not the dinner. It is optionality. If one bank says no, you have another call to make, and that changes who has leverage. Until you make one mistake. You borrow against your investments because the rate looks almost free. Then the market drops hard. The first email says your collateral value has fallen. The second says the bank wants more. You stare at the screen. You are worth more than $10 million, and somehow you are getting the wealthy version of an overdraft warning. That is the irony of leverage. The numbers get bigger. The mechanism does not. If the asset supporting the loan falls far enough, the bank protects itself. So you move cash, reduce the line, and promise yourself never to confuse easy credit with free money again. A few years later, you sell the business. After tax, your liquid wealth jumps past $25 million. Within days, 3 banks want meetings, not loans, you. One bank offers private banking. One offers wealth management. One offers lending so cheap it almost sounds like a typo. Then you notice the detail that matters. Every bank wants a different piece of your financial life. Your deposits, your investments, your borrowing, your business accounts, your future deals. At $25 million, the question is no longer, will the bank approve me? It becomes, what is the bank earning from this relationship? That one question changes everything. You start negotiating fees. You compare lending margins. You refuse products you do not need. And for the first time, a banker says, let me see what I can do. You remember the $35 overdraft fee? Apparently, they can do quite a lot now. Then your wealth reaches $50 million and you find a property deal you love. You assume financing will be easy. You are wrong. The bank rejects the structure, not because you are poor, not because the property is bad, because the bank already has too much exposure to that type of asset. This is another reset. At high wealth, money solves many personal constraints. It does not remove institutional constraints. Banks have their own balance sheets, their own regulators, their own risk limits. Your $50 million does not magically erase those. So you take the deal to another bank. They approve it. Same borrower, same property, different bank. That is what wealth really buys at this stage. Not automatic, yes. More doors. Then the number crosses $100 million. The bank invites you back into the same branch where years ago you argued over $35. This time, the meeting is upstairs. There is a team. Private banking, credit, investments, commercial lending. They want to know what you are buying next. They want your operating accounts. They want your portfolio. They want the relationship. And here is the part that would have sounded impossible when your card was declining. You start asking the questions. What is the rate? What are the covenants? What fees are you waiving? How fast can you close? What happens if I move $50 million somewhere else? Nobody mentions the overdraft fee. At $0, the bank had leverage because you needed access to money. At $10,000, cash gave you breathing room. At $100,000, you became more bankable. At $1 million, you became profitable. At $5 million, debt became a tool. At $10 million, banks began competing. At $25 million, you could negotiate the relationship. At $50 million, You learned even wealth cannot force a bank to ignore its own risk. And at 100 million, the relationship finally flips. The bank still has rules, but now it also has something to lose: you. That is the real progression. Wealth does not make banks nicer. It changes the economics of how valuable you are to them. The bank that once charged you for being $4 short now wants to know what it takes to keep $100 million close. Same bank, different leverage,